Hi, friends. Welcome once again. So, we are continuing the second part of the standard workings, the basic mechanics underlying the consolidation process. Okay, so still the standard five workings. You remember we look at the workings one, so establishing the structure, two, look at the goodwill, three, look at the identifiable net assets of the subsidiary, four, look at the non controlling interest. Five, you look at the group reserves, okay, the consolidated reserves. And then six, continue to put them together in form of the financial statement in terms of the statement of financial position, okay. We looked at an example just of a question, but we did not start calculating. So we are going to pick it up from there and then walk through step-by-step approach. And then we'll look at some other technicalities involved in this particular topic of consolidation. Once again, it is very easy. I'll do my best as I can to explain it down to earth. There's nothing complicated about it. It's just technical, but it's not too complicated, okay? You'll be fine. Let's kick start. So I'll share my slide exactly from where we left off, okay? So this was the example. This was the example we had. Okay, so let me go one step back just to be sure. All right, so this is the final mechanic. Okay, it doesn't matter the order. I have grouped it working number one, number two, number three, number four. Okay, as you could see over here. But trust me, you can decide to work if you think NCI is easy to work first. Work it. Put the structure, the pro forma down, and then fill the gaps in along the line. Okay. If you think working goodwill is working number one, just go by it. It's not rigid for you to say non-controlling interest should be working number four, goodwill should be number two. No. Anyhow you think works best for you. Okay. The workings doesn't normally count in any order. Okay. So let's take the question once again. So on 1st April, okay, on 1st April 2016, Pepper purchased 90%, which tells us that our NCI component is 10%, okay, all things being equal, of Source's share capital at the cost of this. So this is a purchase consideration that they paid, okay, that's a purchase consideration, okay, that's a purchase consideration. This question makes life so easy because it has given us what we paid for. Okay, straightforward. There are times where it can be technical. They will not give you the purchase consideration and you have to derive it. You have to determine it. We'll take an example here and we'll take a more detailed question so that when you meet this in any circumstance, you should be able to compute it. Okay. All right. So here they said we purchased 90% of the share capital of Source for 19 million. At this date, the retained earnings, the pre-acquisition retained earnings, or the retained earnings at acquisition was 3 million. All right. Then the financial statement is given us at 31st March. So 1st April 2016, 31st March 2017 is exactly 1 year. There's no prorata here, so life is easy. Okay. Coincidentally, we make life easy by stating that the investment in the parent company is 19,000, which corresponds to this 19,000. Makes life easy. Okay, we want to make life easy for you. All right. Now, when you add the sum, when you sum these assets, you get this. I think we all know this easy stuff to do. Okay. And then we understand the financials. We have the equity share capital, the retained earnings, okay, and then the current liabilities, giving us this. Look at this question. Look at the table, the financial statement clearly. At the date when the parent acquired a subsidiary, the retained earnings was 3 million. But at the reporting date, 31st March 2017, the retained earnings of the subsidiary has increased to 4,200 or 4.2 million. So it tells you that when we compare this to the 3 million, there's an increase. Okay, there's an increase of about 1.2 million. Okay, these are post-acquisition reserves or the retained earnings post-acquisition. All right, take note of that. Very easy. Okay, Very easy to find this. Okay. Now, based on this, we are also told that the non-controlling interest should be valued using the fair value method. We could also have the proportional method. Okay, the proportional method, which we could use to value the NCI. But the question will always be clear, tell you that use the proportional method or the fair value method. And clearly over here, we're told that at the date of acquisition, the fair value of the NCI is 2 million. So we don't need to worry about determining the NCI value at acquisition. It's already given to us. Goodwill has been impaired by 200,000 since acquisition. Prepare the consolidated statement of financial position for the parent group as at 31st March, as at the reporting date. Okay. All right. So we move on. I'll come back to this again in the next two videos. I think I should make it two. Not to make it so boring. I'll split that video into two. Okay. So in line with this, I will say let's remember this. In line with the basic standard workings, let us remember this step-by-step approach. Make sure you get rid of any investment from the parent, okay, and the share capital from the subsidiary. So from this question, this investment, since it coincides with this 19 million, will be gotten rid of. And the share capital of the parent, of the subsidiary, will be gotten rid of when consolidating. When consolidating, okay, that's the first step. Again, we add together all the assets and the liabilities. So we end up adding this to this, okay? We add the current assets, okay? Any liabilities, we add it. That's another step. Very easy. Very easy, okay? And then the next step tells us that we find the impact of fair values. I've highlighted it red because we'll look at it again towards the end of this particular slide, this particular lecture slides. So I've highlighted that one in red. We'll look at it. This question doesn't have much of fair value. It doesn't have any fair value. So we'll look at another example. Then we calculate the goodwill. We find the consolidated reserve group reserve figure. And then we find a non-controlling interest. We've already been given a non-controlling interest at acquisition, okay? But we need to adjust. There's an impairment of goodwill. We don't own 100% of the company. We own 90%. I say we because I'm putting myself in the shoes of the parent. Okay, we don't own all. We own 90%. So whatever risk and rewards, we must share it with our non-controlling interest. So they will take the 10%. All right. And then any post-acquisition retained earnings from the subsidiary, this excess, we need to share it with them. We cannot take everything. We take 90%, NCI takes 10%, okay? So we move on, and then we complete the consolidation by finishing off the calculation. The ones we've added, we add. The ones we subtract, we subtract. The ones we multiply off, okay? So I'll start with my workings first. In no particular order, anyone can come. So first, we are told that at 1st May 2016, I acquired 90%. The parent acquired 90%. That's the first step. So it tells you the parent has 90%. And then the NCI will take 10%. Okay? I establish my group structure. Then I calculate the net identifiable, the identifiable net assets of the subsidiary, which I need for my consolidation, for my goodwill calculation, for my transfer to the NCI, and for my reserve calculation. So first and foremost, what was the share capital of the subsidiary? If you look at the question, it was 10,000 or 10 million. Okay, all figures here are held in millions, okay, in thousands. Okay, so this, let's say, is in thousand. This is in thousand. Okay, and this is in thousand. All right. So it was 10 million. So at reporting day still remains 10 million. So everything works off in terms of post-acquisition. Everything goes off, okay? It should be pound, not dollar, okay? Then at the date that we acquired the subsidiary, we said it had a retained earnings of 3 million. But as at the reporting date, okay, as at the day that we are reporting this, that's the 31st March, right? 31st March 20X7, it was 4,200. it tells us that there is a post-acquisition element of 1,200. The question is straightforward. We don't have fair value in the question. We would have adjusted it here. We don't have depreciation of any fair value. We would have adjusted it here. We don't have any unrealized, we don't have any amortization, anything we want to adjust here. Let me take you a step back to the detailed pro forma. Okay, let me take you a step back to the detailed pro forma. Assuming we had all those elements, we would have kept all of them within this particular item. Okay, so the share capital, we treated it, and we have the retained earnings. Okay, we don't have any other component of equity for the subsidiary. If there was a share premium, any reserves, revaluation reserves, which is part of other components of equity, we would have recognized that one. Okay, any fair value adjustment, we don't have any fair value. This was a basic, straightforward one. Any provision for unrealized, we would have considered that somehow. Okay, we don't have anything in that scenario. No intra-group trading, and then no post-acquisition depreciation of the fair value. So it's straightforward. So we've captured almost everything there. Okay, so in the question, it is more or less looking at these two elements only. Okay, these two elements only. Let's go back to the question. Let's go to the question. So that's it. For the subsidiary, it was only the share capital, right? And then the retained earnings. That's all. Okay, that's all. So we take care of the 10,000. The date at which we acquired retained earnings was 3 million. And then at the reporting date, it is now 4,200. So we can determine our post-acquisition, okay, elements. So at the end of the day, when we sum this up, the fair value of the identifiable net assets of the subsidiary is 13 million or 13,000 if we hold the thousands up constant. This is what we will transfer in terms of calculating or determining our goodwill when we bring into place the NCI value at acquisition, the amount we paid, and looking at these shares, these assets of the subsidiary at acquisition. Okay, and then these elements, the only thing we had here was the post-acquisition reserves, 1,200. We'll share it. Okay, so of the 1,200, we will take 90% for the parent. Okay, we'll take 90%. Okay, 0.9 times 1,200. We will take 1080. Okay, we will take 1080, and then the subsidiary will take, so the NCI will take 10% of this, which gives us 120. Okay, so that's it for this particular element. We'll keep them. We'll transfer them to the appropriate sections. Easy to get this one, all right? Basic, easy to understand. Now, we now calculate the goodwill. In the question, it says we purchased 90% of the shares of the subsidiary for 19,000. That's what we pay, the cash consideration. Then we need to add the fair value of the NCI at acquisition. The question clearly told us that the fair value of the NCI at acquisition is 2 million. We add it. Okay, and then we subtract the fair value of the subsidiary's identifiable net assets, which we just worked, 13,000. Okay, from the previous slide, the whole of this, we subtract it. Okay, the whole of this, we subtract it. So we take it out of the sum, we get 8 million as goodwill at acquisition. The question then goes on to tell us that there was an impairment of 200. Okay, so this impairment must be taken care of. We subtract, we get 7,800. So look at it carefully. Do we own 100%? No. We own 90%. So we need to split this one as well. If there are any risk and rewards, we split it. Okay. Parents need to take its share, and then NCI must also take its share. Okay. Parent takes its share, and NCI also takes its share. Okay. When we come to the reserve computation and when we come to the NCI computation, we look at that. Okay, so then the goodwill at the reporting date, but the statement of financial position, which will transfer, which we'll use in the final calculation, is 7,800. All right, easy, straightforward. Now, in terms of the NCI, we need to now find the full value of the NCI. So we were told in the question, okay, at acquisition, here I said as per workings, or some, in clearly we can say as per question. Okay, the question tells us that the NCI at acquisition was 2 million. Okay, now the NCI's share of the post-acquisition reserve was 10% of the post-acquisition retained earnings of the subsidiary was 120. I think we did a calculation here. Okay, here is it, the 120. We add it. We add it. And then the goodwill that is impaired, the impairment value. If you have taken a share of the extra profit we made, you must also take a share of the loss that is coming up over here. Okay, so he would take 10% of 200 is a loss. We subtract it. Okay, that's it. We subtract it. And that is all we have for the NCI for now, basically. Okay, so we add them, the ones we need to add, we subtract, and we get 2,100, and this is what we use or we consider in our statement of financial position at the reporting date. Now, finally, we look at the reserves, consolidated reserves. We are not interested in the subsidiaries when we are talking of the parent. So what was the parent's retained earnings? 100% of it. Go back to the question, and you see the question says that the retained earnings of the parent is this. We don't have to sum the two up. Only that of the parent for now. Then we adjust. So 13,100 is what we had for the parent. Okay. The parent had a 90% share of the post-acquisition reserves of the subsidiary. That gives us 1080. And then the parent will also take 90% of the impairment, goodwill impairment, which gives us 180. Okay, so do the additions and subtractions and you get 14,000. We are done. We are basically done. Then we go into our statement of financial position and do our consolidations. Okay, so we add the assets, straightforward, PPE. Goodwill is what we work. It's a new item we introduce, 7,800. Current assets, we just sum them up on the line. Nothing to do for now. We get this, we sum them up, we get 55,000. Under the equity section, we need to only look at the share capital, okay, of the ordinary shares of the parent only, which is 30,000 from the financials. No need to bring in that of the subsidiary. And then we find the retained earnings of what we just worked, the working number 5, the group consolidated reserves. We bring it here, we add it, we sum it, and then we introduce the new element of the NCI, which we computed, 2,100. Okay, sum them up, we get 46,100, and then the current liabilities, nothing to do now. Just sum the line items up, and you get your final figure to be 55,500. Very easy and straightforward. Okay, all right, let's progress. I'm still looking at my time. Hopefully, we'll go beyond the 30 minutes, but let's see. Let's take this simple example. NCI valuation, using the fair value and using the proportion of net assets method. We've looked at this in the computation of the goodwill, but let's try and revisit this. Sometimes it confuses us. But in the question or in an exam, you'll be clearly given one scenario. You'll be given one scenario, not both, okay? Else you may end up confusing yourself. Okay, so Daniel acquired 80% of the 50,000 ordinary shares. 50,000 valued at 1 par value, ordinary shares of Craig on 31st December 20x6. And he acquired it for how much? For 78. At this date, the net assets of Craig was 85. What goodwill will arise on acquisition if NCI is valued using the proportionate share of the net asset? Proportionate share of this. Okay, so NCI's portion is what? 20%. Proportionate share of this. What goodwill will arise? What goodwill will arise on acquisition if NCI is valued using the fair value? And we are told that the fair value is 19,000. This is similar to the question we looked at where we say NCI at fair value was 2 million. Okay. Show how the fair value of the NCI could be calculated if the market price of Craig was 1.9 at acquisition. Quite straightforward. Okay. Quite straightforward. Very easy. Okay. So now let's move on for the first part, A. So we are told that the fair value of what we paid for the acquisition, what Daniel paid for the acquisition was 78. That is it. Okay. Now, NCI's value in terms of proportionate, and I think I did the arrow, okay, is 20% of the net assets of the subsidiary, okay, which gives us 17,000, okay, 17,000. So, zero point 0.2 of 85, that gives us 17,000, okay. Then we subtract the total identifiable net assets of the subsidiary, fair value, which is 85, and we get a goodwill on acquisition at 10,000. This is one way of identifying or calculating goodwill when NCI is valued as a proportionate. It has a proportionate share as a proportion of the net assets of the subsidiary. What if it is at a fair value when we are given the figure as 19,000? Same story holds. We did a purchase price. We purchased for 78. The fair value per question of the NCI, okay, is 19,000. We add it up. We get 97. And then we subtract again the fair value of the identifiable net assets of the subsidiary, everything. And then we get goodwill at 12,000. So depending on the approach that the company uses, its goodwill could be higher or lower, depending. Okay. So sometimes people will play fast, smart. They look at IAS 8, accounting estimates and errors and those policies, and they decide to choose which one best serves their interest. Okay. So sometimes accounting can be choose and pick, can be more of a picky one. Choose which one helps you. All right, let's move on. Let's take another example. Oh, sorry, the same question. Okay, we've not done. The second part of the question is saying that what if, how can we value the NCI provided it is calculated at, how could we calculate it if the market price of Craig's share was 1.9? So remember, what was the NCI component? 20%. So 20% of these are the fair value of the shares. Very easy, straightforward, okay? So sometimes you'll be asked to compute the fair value of the NCI. Listen, I'm going too fast. So sometimes you may be asked, in the first instance in this question, we can be given the fair value of the NCI as 19. Or they can tell us to value it as a proportion of the net asset, in which case we will determine. They can also ask us to determine the NCI. Nobody will give you the fair value or the proportion. They say determine it based on the share, the market share, the current market share price of the subsidiary. Okay, and that's the scenario here. So remember, we own how many? 20% of the ordinary shares multiplied at the prevailing market price. That's it, 19,000. Okay, so no wonder, coincidentally, this is giving us the 19,000 as a fair value of the NCI, okay, of the NCI. So it's so easy. Sometimes we'll be asked to value it using the share, okay. In an exams, it will be clear. They will tell you which one to use. If the question is so silent, you can easily infer from it, okay. At this point, I'll ask you to attempt the test your understanding question 1 from chapter 18, okay, and then we move on. All right. Again, the fair value of consideration. In the questions that we have looked, it was so easy. They told us that we paid 19,000, we paid 78,000, okay, we paid 19 million. It's so easy. They've given us. But it's not that straightforward. Sometimes we may be asked to determine the price ourselves. That brings in the complications. Sometimes we may be asked to determine it. So in calculating goodwill, purchase consideration should always be at a fair value. Now, we can pay cash, in which case it's easy. Let me point this one out. Whether we pay by cash, whether we pay by a future cash payment, a deferred cash payment, or shares, we issue shares, or we issue a deferred shares or contingent consideration. Anyhow we want to do it, we will always debit the cost of investment in the books of the parent. That's the first approach. It's an investment. So we always debit the cost of investment in the books of the parent. If we paid cash, then it means cash was given out. So we credit cash. Easy, right? Now, let's say we promise you that, listen, we want to acquire a company, but we'll pay you cash at a later date. We'll give you 2 million in 3 years' time, but we want to acquire the company. And we agree and we take the company. Okay? That's a deferred cash. Remember, if I'm promising to give you 30 million in 3 years, in 3 years' time, know that this 30 million in 3 years' time is actually lower today. the present value of 30 million in 3 years' time is higher than today. It's lower than today, actually. It's lower. Okay. So if I promise you that I'll give you 30 million in 3 years, and I give somebody 30 million today, the one who has 30 million today is better off than you because he can invest and he can get interest on it. Okay, so time value of money comes into play over here. So in terms of deferred cash, we use the present value. We take an example and you will understand better. So it is a deferred cash. More or less what we are saying is that we owe him. We owe this guy. We've taken over his company. We said we'll pay him 30 million in 3 years' time. So we need to create a liability. Okay. There's no cash yet we've given to him. We need to create a liability. So you credit the liability. In 3 years' time, when it matures, what you do is that you debit the liability to clear out the balance, and then you credit the cash or the bank. Okay. Now we could also give you shares at acquisition. So instead of giving you cash, we'll give you shares. Okay. So if the cost of the investment is 1 million, okay, that's the cost of the investment. And then we realize that the shares we are giving you is actually like 900,000. And then the remaining goes into, let's say, share premium. Okay, same mechanics. Okay, debit the cost of investment, credit the share capital of the parent. It means the share capital of the parent increases. So I've seen a situation, I think the recent exams where students were given this share acquisition. And I think most students found it difficult to know how they can treat this. How can I treat this share capital? They are giving us shares. They are not paying cash. So how do I do it? Okay. So that's what happens in this instance. We could also give you a deferred share. We'll not give you the shares today, like in the cash. We'll give you later. In 3 years, we'll give you this block of shares. The same scenario lies here, like in the case of deferred cash. Instead of crediting liability, credit other components of equity. Credit other components of equity. And when the time matures, you just reverse the transaction. And then we could also be asked, you could also tell you that contingent consideration. In this scenario, the exams, if it's in an exams, you'll be given, the question will give you so much detail to help you calculate the contingent consideration. But again, depending on the kind of contingency, it will be either you credit the liability or the equity. Question will be very clear. Any professional fees we incur, the legal charges we incur in the acquisition, should just be charged as expenses. Don't capitalize it. Don't include it in the cost of the acquisition anywhere. Just expense it off into the profit and loss account. Okay. All right. Let's take an example. Fair values. Fair values of consideration. This is a detailed one. And I'll take my time and explain this. Pearson acquired 60% of the 100,000 share. Par value 1 ordinary shares in Shakespeare on this date. The purchase consideration is made up of the following. All right. I'll take my time and explain. Forget about the timing. I think my time is running, but don't worry. I'll take my time. Even if we get to 40 minutes, it's worth it, okay? So the purchase consideration is made up of the following. We have not been given the exact amount. We need to find it, okay? A share exchange of 2 shares in Pearson for every 3 shares acquired in Shakespeare. So for every 3 shares in Shakespeare, the parents will give you 2. Okay? So that is what? 2, right? Okay, so that is what? 2 for 3. Okay? So it is 2 for 3 times what? The 60% of how many shares in Shakespeare? Of 100,000, okay? Of 100,000 shares. Okay? Times the share price at acquisition. Times the share price at acquisition. Okay? That is the first one. Then they said that the second point is that in addition to this share price, in addition to this share that we give to you, we are also going to give you an issue of $100, 10% loan notes for every 500 shares acquired. Again, they are saying that for every 500 shares, we'll recognize a loan in your name. It's like we are owing you. So for every 500 shares, listen, let's consider it as a loan you've given it to us for $100. That's what they are saying. So again, it will become what? $100 for what? 500. It's the same as 2 for 3, okay? So it is 100 for 500, okay? $100 for 500 shares, okay? So 100 for 500 times what? The 10% is just the interest that will pay on the loan, okay? Times 60% shares that we are holding times how many? How many shares of the subsidiary of 100,000? So this one is clearly done. We can easily calculate this and get the answer, okay? But here we are here to find the share price. That's why I have left it hanging. Then the next one, they are told that I will pay you in addition to the share exchange, in addition to the loan exchange, we are also going to give you a deferred cash, okay, of 1.21 per share, payable on 1st April 2018. So consider the date. Look at the time. Look at the time that we acquired the company, 2016 April to 2018. That's 2 years, right? That's 2 years. So once again, the money that will pay you in 2 years is not the same as, the value is not the same. Time value of money. If you remember your financial management, this comes into play where we find the time value of money. You need to discount it with a discounting factor, okay? So again, here we said what the cash deferred, okay? Cash deferred. So it is you remember your discount factor. So your discount factor will simply be 1 over 1 plus the rate to the power n, where n is the number of years, okay? So you get 1.21, right? Times whatever deferred cash we are given per share. Remember, they said this is per share, okay? So how many per share are we getting? We are taking 60% of the 100,000 shares, okay? That's the shares. So 1.21 times this number of holdings we have in the company times the discount factor. So 1 over 1 plus the discount rate. And the question should clearly give it, tells you that there's a cost of capital of 10%. Okay, 10%, so 0.1. All raised to the power of how many years? 2. And we can easily calculate this. All values have been given. The value of each Pearson share at acquisition is 2.2. The value is 2.2 at acquisition. So this is where we bring in our acquisition 2. Okay, 2.2. Then we calculate. So the answer we get here, answer number 1, plus answer number 2, plus answer number 3, will give us our fair value of the consideration we paid. Fair value of the consideration paid. Okay, so there are times where things can be complicated, and you find this more in the professional exams, where you have to determine the value, the fair value of the consideration. The answer is on the next page, okay? So I can easily pop it in. So like you understand, the share exchange, 60% is what we are holding of the 100,000. And we are giving you 2 for every 3. And the share price, the market value of the shares, not the issued share price, okay? So take a look at this place. The authorized face value, par value is 1. At the time when we started the company, the par value of each share was 1. But currently, at the time we are purchasing, we are selling our company. Okay, at the time that Shakespeare is selling his company, each share value is no longer 1. The market price of the share is 2.2. So you don't use 1. You use the market value, the current fair value of their shares. Okay, all right. So that's what we have in here, which is 2.2 gives us this amount. All right. For the loan, every 500 shares will give you 100. 100 for 500 times our holding, our shareholding. Okay, and then it gives you 12. And then for the deferred cash, we'll give you 1.21 for the total shareholdings. But we need to discount it at the discounting factor, okay? 1 over this is a discount factor, okay? This is a discount factor. If you have the discount factor table, you can use it, okay? Otherwise, you want to calculate it, and then you see you get 60. So when you add everything, you get 160,000. This is the fair value of consideration that you paid, which you will use to identify the goodwill. All right, great. Let's move on. Okay, so once again, let's take another example. P acquired 60,000 of S's 5,000 shares. So at the time of incorporation, the face value of the share was 1. We acquired 60% of the 5,000 on 1st July. We paid cash. So have you seen we paid cash as part of the consideration? They said P also issued two $1 share for every 5. What does it mean? 2 for 5. Okay. So we also have 2 for 5. It's the same story. So it is 2 for 5 times our shareholding, 60% of the 5,000 shares we hold, okay, times the share price. Times the share price. It is not the par value of the share, but the market value, the current market value, okay, of the share. So it goes on to say, and agree to pay a further 2,000, a deferred cash in 3 years' time. Okay, so it is this times the, so P shares at 31st July, the date on which we acquire was 1.8, so times 1.8. This is number one. Number two, we pay the cash. Okay, cash paid of what? 5,000. So this is straightforward, 5,000. Okay, and then they said we are going to pay number three, a deferred cash. Okay, deferred cash payment of how much? 2,000 in 3 years. So there they've even given you the figure 2,000 straightforward. You need to just work it. So simply 2,000 that will pay you in 3 years is not the same value today. So we need to discount it. Okay. So we get our 2,000 times our discount factor 1 over 1 plus the rate. Let's read whether there's the current interest rate. So current interest rate, cost of capital, yield to maturity, annualized yield. Anyone they give you is the same as the cost of capital. Discount rates, anyone, okay, is 6. So it comes 0.06, right? In how many years? In 3. This is the third item. Okay. So when we add 1, 2, and 3, it gives us the price, the fair value that we paid as consideration to acquire the subsidiary. Okay. So that's the solution I've plotted there. Cash straightforward. Okay. The 2 for 5 times the share price, okay, times the 5,000, the holding that we had, gives us 2160. And then the deferred cash payment, the 2,000 discounted over 3 years, gives us 160. It tells you that the 2,000 we are promising to pay them in 3 years. Today, the value of that 2,000 is actually what? 1,679. So in effect, we are going to pay a total of 8839. 8839. All right. Time is far gone, but let's run through this quickly. Otherwise, I'll end here and I'll come back to the fair value. Okay? I'll come back to the fair value. All right. So I'll end here. That's 38 minutes. I'll end here and I'll come back to the fair value in the next section to wrap it up easily. All right. Good. I'll see you soon. Thank you.